On Wednesday, January 28, 2026, the Federal Reserve held interest rates steady at a range between 3.5 and 3.75%. The decision passed with a 10-2 vote. 2 governors dissented, voting instead for a quarter-point reduction. Those 2 governors were Miran and Chris Waller. Both were appointed by President Donald Trump. Miran was confirmed in September 2025 to fill an unexpired term ending January 31, 2026. Waller was confirmed in December 2020 during Trump's first term. At this stage of the cycle, as we move into February 2026, this split vote represents something far more significant than ordinary monetary policy disagreement. What we're witnessing is the mathematical convergence of structural forces that have been building for decades, now manifesting in ways that feel sudden, but are actually the inevitable result of incentive structures, institutional erosion, and historical patterns repeating with precision. I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. The Federal Reserve was established in 1913 with a foundational principle that has underpinned American monetary stability for over a century: independence from political pressure. Central bank independence exists not as an academic preference, but as a historical lesson written in the catastrophic inflations and financial collapses that occur when elected officials gain direct control over money creation and interest rate policy. The Federal Reserve Act stipulates that governors serve 14-year terms and can only be removed for cause. This structure was designed specifically to insulate monetary policy from the electoral cycle, preventing short-term political incentives from overriding long-term economic stability. Every major economy that has compromised this separation has paid a measurable price. In the United States during the 1970s, President Richard Nixon pressured Federal Reserve Chair Arthur Burns to ease monetary policy ahead of the 1972 election. Burns complied. The result was inflation that reached double digits and took more than a decade to defeat, requiring interest rates above 15% and 2 recessions. The wealth destruction was enormous. Real purchasing power collapsed. Savings evaporated. Fixed-income retirees saw their lifetime accumulations cut in half. Argentina provides a more extreme case study. When executive power repeatedly captured central bank policy to finance government spending, the result was hyperinflation exceeding 3,000%, multiple currency collapses, and the complete destruction of the middle class. Germany's Weimar Republic offers the definitive historical example. When the central bank became subordinate to fiscal demands, the resulting hyperinflation destroyed an entire economy in months. People's savings became worthless overnight. The social fabric disintegrated. The political consequences were catastrophic. The pattern is mathematically consistent across every instance. When central banks lose independence, inflation accelerates, currencies weaken, real assets flee to safety, and wealth concentrates dramatically while the broad population experiences severe financial stress. The mechanism is straightforward. Politicians face electoral pressures to stimulate growth and employment in the near term, even when such stimulation risks overheating the economy and generating inflation. Central bankers, insulated from these electoral concerns, can make decisions based on longer-term stability. Remove that insulation and the incentive structure collapses toward short-term political expediency. Current events are mapping precisely onto this historical template. President Trump has maintained consistent public pressure on Federal Reserve Chair Jerome Powell since 2018 to cut interest rates more aggressively. He has called for rates as low as 1%, a level that virtually no mainstream economist believes appropriate given current economic conditions. The pressure has escalated systematically. In August 2025, Trump attempted to fire Federal Reserve Governor Lisa Cook based on allegations of mortgage fraud that her legal team vigorously contests. No president in the Federal Reserve's 113-year history has successfully removed a sitting governor. The Supreme Court heard oral arguments in January 2026, with several justices expressing skepticism about Trump's justification. In January 2026, the Justice Department issued grand jury subpoenas to Powell regarding congressional testimony about cost overruns on the Federal Reserve headquarters renovation. Powell responded in an unusually direct video statement, calling the investigation a pretext to pressure the central bank into lowering rates. This marked an extraordinary public confrontation between the executive branch and the Federal Reserve. Trump appointed Stephen Miran in September 2025 to fill a brief, unexpired term. Miran had previously advocated for structural reforms to the Federal Reserve, including reducing governor terms from 14 years to 8 years, and allowing presidents to fire board members. Since joining the board, Miran has dissented at every meeting, consistently voting for larger rate cuts than the majority supported. At the September meeting, he voted alone for a half percentage point cut. At the October, November, and December meetings, he again dissented. At the January meeting, he was joined by Christopher Waller in voting for a quarter-point reduction when the majority voted to hold rates steady. This creates a specific mathematical problem for institutional stability. Of the 12 voting members of the Federal Open Market Committee, 7 are governors appointed by the President and confirmed by the Senate. The other 5 positions rotate among regional Federal Reserve Bank presidents. Trump has now appointed 3 of the 7 current governors, Miran, Waller, and Michelle Bowman. If Trump's nominee Kevin Warsh is confirmed, Trump will have appointed 4 of 7 governors. If Powell leaves the board when his chairmanship expires in May, Trump could appoint a 5th. That would give Trump-appointed officials a majority on the board. If Lisa Cook is successfully removed, that majority strengthens further. The regional bank presidents, traditionally more independent, would be outvoted. The incentive structure becomes clear. Governors who vote consistently with presidential preferences may secure reappointment or elevation. Those who resist may face investigation, removal attempts, or public criticism. This creates a powerful selection mechanism. Over time, it filters for compliance. The result is not theoretical. It's playing out in real time through dissenting votes that align precisely with executive branch preferences. Most people miss this because they focus on individual events rather than systemic convergence. They see a dissenting vote as normal monetary policy disagreement. They see an investigation as an isolated legal matter. They see an attempted removal as a personnel issue. They don't recognize these as coordinated components of a structural transformation. Historical precedent shows how this accelerates. Initial pressure seems manageable. Individual instances appear controversial but contained. Then multiple pressures converge. Legal threats combine with political attacks and personnel changes. The institution begins responding to the cumulative pressure rather than independent analysis. By the time the transformation becomes obvious, it's already complete. We can map the current situation precisely onto historical analogs. The Nixon-Burns dynamic in the early 1970s provides the closest parallel. Burns was initially respected for his independence. Nixon began with public pressure for rate cuts to support employment ahead of the 1972 election. Burns initially resisted. Nixon escalated with private meetings, public criticism, and implied threats. Burns gradually accommodated. By 1972, the Federal Reserve was effectively subordinate to electoral timing. Inflation, which had been declining, reversed sharply upward. By 1974, it exceeded 10%. By 1980, it reached 14%. The wealth destruction was systemic. Real wages fell for a decade. Savings lost half their purchasing power. Housing became unaffordable as mortgage rates hit 18%. Stock markets adjusted for inflation produced negative returns for 15 years. The pattern repeats with mechanical precision. This cycle likely accelerates faster than historical precedents for specific structural reasons. Modern financial markets are vastly more interconnected and move at digital speed. Information asymmetries are smaller. Algorithmic trading responds to institutional signals instantaneously. If market participants begin pricing in reduced Federal Reserve independence, capital flows adjust before policy even changes. We're already seeing early indicators. Treasury yields have become more volatile. The yield curve has inverted and re-inverted multiple times, historically a recession signal. Currency markets show increased dollar weakness against safe haven alternatives. Gold has reached record highs. These are not random fluctuations. They represent rational market responses to institutional uncertainty. Real people experience this through specific transmission mechanisms. When central bank independence erodes, inflation expectations increase. Businesses raise prices preemptively. Wage negotiations become adversarial. Long-term contracts become impossible to price. International investors demand higher yields to compensate for institutional risk. Those higher yields mean higher borrowing costs for mortgages, car loans, business expansion, and government debt service. The fiscal implications compound geometrically. The United States currently carries over $35 trillion in federal debt. Each percentage point increase in average borrowing costs adds hundreds of billions in annual interest expense. This forces impossible choices between default, inflation, or spending cuts. Historical examples show governments consistently choose inflation because it's politically easier than explicit default or cutting popular programs. But inflation is simply default by another name, stealing purchasing power from savers and fixed-income recipients. Common objections to this analysis typically follow predictable patterns. Some argue that Trump-appointed governors can still act independently once confirmed. This misunderstands incentive structures. While individual governors may have personal integrity, the selection mechanism filters systematically for those willing to accommodate executive preferences. The dissenting vote pattern since Miran's appointment demonstrates this empirically. Some claim market discipline will constrain any inflationary policy. This ignores the lag structure. By the time markets fully price in institutional degradation, enormous damage has already occurred. The 1970s showed markets can remain mispriced for years while real wealth evaporates. Some suggest congressional oversight provides a check, but Congress has shown limited willingness to defend institutional independence against executive pressure, particularly when the same party controls both branches. Some argue modern central banking techniques make 1970s-style inflation impossible. This represents dangerous overconfidence. The fundamental mechanism is unchanged. If the central bank subordinates policy to political pressure, inflation follows. No technical innovation eliminates this relationship. Some point to Powell's stated commitment to independence as reassuring, but Powell's term as chair expires in May 2026. Whether he remains as a governor is uncertain. Even if he does, a single vote cannot override a board majority aligned with executive preferences. The systemic convergence we're witnessing involves multiple reinforcing dynamics. Personnel pressure through appointments and removal attempts. Legal pressure through Justice Department investigations. Public pressure through presidential statements and social media. Market pressure as yields rise in response to institutional uncertainty. These pressures don't operate independently. They compound. Each additional pressure point makes resistance to the next pressure more difficult. An institution can withstand one or two simultaneous pressures. When 5 or 6 operate simultaneously, structural failure becomes highly probable. We can observe this through voting patterns. In December 2025, the Federal Open Market Committee voted 9-3 to cut rates by a quarter point. Miran voted for a half-point cut. 2 other members voted against any cut. In January 2026, with new rotating regional bank presidents joining the voting membership, the committee voted 10-2 to hold rates steady. Miran and Waller voted for a quarter-point cut. This represents increasing dissent from Trump-appointed governors. As of now, Trump appointees represent 2 of the 12 voting members who are pushing for more aggressive easing. If Warsh is confirmed and replaces Powell in May, Trump appointees could represent 3 or 4 voting members, depending on whether Powell stays on as a governor. If regional bank president appointments come up for renewal and White House pressure influences those selections, the composition shifts further. The mathematical trajectory points toward a voting majority aligned with executive preferences within 12 to 18 months. Once that majority exists, monetary policy effectively becomes subject to political control. The forward-looking transition to the next phase follows a predictable sequence. First, confirmation hearings for Warsh will reveal the degree of Senate concern about Federal Reserve independence. If confirmation proceeds smoothly, despite ongoing Justice Department investigations and removal attempts, it signals institutional acceptance of executive control over monetary policy. If confirmation faces serious resistance, it may slow but not stop the transformation. Second, Powell's decision about remaining as a governor becomes critical. If he stays through January 2028, he maintains one independent voice. If he leaves, that seat likely goes to another Trump appointee, accelerating the shift. Third, the Lisa Cook Supreme Court decision will establish whether presidents can remove governors without traditional cause. An adverse ruling eliminates the primary statutory protection for independence. Fourth, we'll see whether the Justice Department investigation of Powell continues or concludes. If it continues after Powell's chairmanship ends, it establishes investigation as a tool for influencing sitting governors. Fifth, voting patterns at subsequent Federal Open Market Committee meetings will show whether the dissenting bloc expands. If it does, we'll know the selection mechanism is operating as expected. Each of these developments is observable and measurable. Together, they indicate whether the structural transformation continues or encounters effective resistance. Historical analysis provides clear guidance on what happens next if institutional independence continues eroding. In the near term, markets will demand higher risk premiums. Treasury yields will rise despite Federal Reserve rate cuts because investors will price in future inflation risk. The dollar will weaken against currencies backed by more independent central banks. Real assets like gold, real estate, and commodities will appreciate as inflation hedges. In the medium term, actual inflation will manifest as the Federal Reserve accommodates fiscal expansion and maintains rates below neutral levels. The Personal Consumption Expenditures Index, currently at 2.8%, will trend higher. 3% becomes 4%, becomes 5%. In the longer term, if inflation becomes entrenched, defeating it requires the kind of aggressive tightening Paul Volcker implemented in the early 1980s. That meant interest rates above 15%, back-to-back recessions, unemployment above 10%, and a decade of economic pain. The wealth destruction occurs across multiple channels simultaneously. Savers lose purchasing power. Fixed-rate borrowers benefit temporarily, but face refinancing at much higher rates. Variable-rate borrowers face immediate payment increases. Retirees on fixed pensions experience real income collapse. Workers see real wages decline even as nominal wages rise. Small businesses face impossible financing costs. Large corporations with cash reserves and pricing power capture market share from failing competitors. Wealth concentrates dramatically at the top. International consequences compound domestic problems. As the dollar weakens, import costs rise, feeding inflation further. Energy prices increase. Foreign holders of dollar assets reduce exposure. The Treasury faces higher borrowing costs precisely when deficits are expanding. International confidence in dollar reserve status begins questioning. This process plays out over years, not months, but the direction becomes clear well before the full damage materializes. The mathematical structure of what's unfolding is not speculative. It's observable through public voting records, documented legal proceedings, and measurable market responses. 2 Trump-appointed governors voted for more easing at the most recent Federal Open Market Committee meeting. The president has nominated a 3rd appointee. A Justice Department investigation targets the sitting chair. A Supreme Court case threatens the removal protections that underpin independence. These are facts, not predictions. The historical pattern is equally clear. Every major economy that has subordinated monetary policy to political control has experienced inflation, currency weakness, and wealth destruction. The United States in the 1970s, Argentina repeatedly, Turkey currently, Zimbabwe catastrophically, Germany historically. The pattern holds across different political systems, different eras, different economic structures. The causation runs directly through the incentive misalignment created when short-term political pressures override long-term stability considerations. The current convergence of personnel changes, legal pressure, and public criticism creates the same incentive structure that has produced the same outcome historically. The scale of potential wealth destruction depends on how far the erosion of independence proceeds and how quickly markets price in the implications. A modest erosion might produce inflation similar to the 1970s, destroying perhaps 30% of real purchasing power over a decade while requiring brutal tightening to restore stability. A severe erosion could produce outcomes more similar to Argentina, with sequential currency crises and the effective elimination of domestic savings as a store of value. The very worst case, while unlikely, mirrors Weimar Germany, where complete subordination of monetary policy to fiscal demands produced hyperinflation that destroyed the social fabric itself. We are watching institutional foundations that have underpinned American prosperity for over a century come under systematic pressure. The Federal Reserve's independence is not an abstract principle. It's the specific mechanism that has kept the dollar stable, maintained low inflation, enabled long-term planning, and made the United States the preferred destination for global capital. When that mechanism breaks, the consequences follow with mathematical precision. They feel sudden because most people don't see the structural pressures building. They notice the inflation only after it arrives. They notice the currency weakness only after their imports cost twice as much. They notice the wealth destruction only after their savings have lost half their value. But the causation is mechanical and predictable. Political control of monetary policy produces inflation. Inflation destroys real wealth. The destruction concentrates most heavily on those least able to hedge: workers, savers, retirees, small businesses. Those with access to hard assets, international diversification, and pricing power survive. Those without such access suffer the full impact. At this stage of the cycle, the structural forces are converging. The personnel changes are accelerating. The pressure mechanisms are operating simultaneously. The voting patterns are shifting measurably. The market signals are emerging. Everything that history tells us should happen when central bank independence erodes is beginning to happen. The outcome is not certain because human institutions can surprise, resistance can emerge, legal protections can hold, political pressures can reverse. But the probability distribution is heavily weighted toward continued erosion and its inevitable consequences. Understanding the mechanism doesn't require predicting exact dates or magnitudes. It requires recognizing the structural forces at work and the historical patterns they reliably produce. Those forces are observable now. Those patterns are beginning to manifest now. The wealth destruction they threaten is not a possibility for some distant future. It's a mathematical consequence already in motion, visible to anyone willing to look at the underlying architecture rather than the surface headlines.